Yeah, I love this topic because if you go back and you just look at where this all started, it actually started in 1996 with what was called the Boskin Commission. And back then, what they were looking to do was to make the numbers look prettier and to reduce the deficit, because back then modern monetary theory was not as popular. So people didn't believe that you could just print money to infinity without there being some type of consequence. So they wanted to lower the deficit. It was a good political move. And actually, in that commission report, you read that they projected CPI was off by 1.1%. So
Oh,
because CPI was off by 1.1%, we should rethink how we do everything. So, I mean, it's just ridiculous. And that change is really the catalyst to what's leading to the multiple percentage point inaccuracy that we see today. But to keep it short and simple and sweet, we used to use what was called a cost of goods index. And the cost of goods index was used to measure the cost to maintaining a standard of living. So, if you're eating filet mignon and the price of filet mignon goes up, then that affects the cost to maintain that standard of living of eating filet. But after the commission, what you find is that they actually switched their analysis to use what's called a cost of living index. So we went from cost of goods index to cost of living index. And the cost of living index is based on the cost of maintaining a given standard of living. So not the standard of living with a fixed basket, a given standard of living. So the way it works is it's substitution, it's hedonic. So if the price of filet goes up, but the price of hamburger meat goes down, they have the ability to ignore the price increase in filet and to apply the price decrease of the hamburger, because beef is beef, right? And then chicken is chicken. So, if ground chicken is cheaper, but chicken breast is higher, they'll go with the ground chicken. And the same thing with all types of meats and all types of categories that we're in. So they literally get to look at the categories, the subcategories of the major categories, and pick what they want to substitute. And the justification for that is, well, when prices go down, people change their spending habits. Yeah, but the point of CPI is to measure the cost of a standard of living, not a given standard of living, because the given part there allows them to change and redefine that standard. So even with all of these manipulations that took place from going from the cost of goods index to the cost of living index, they're still not able to get the numbers down to where they need to be. And I'm not sure if you saw or not, but I'm actually working on this website called Govflation, where, because Trueflation was already taken. What a waste. What an absolute waste
I
of a
know.
great name.
I
It's
know.
like you go on there and it's like the number is lower than the government number. It's like, are you shitting me? What? The numbers like that Trueflation, I think Trueflation was financed by the same people who are pulling the strings, and that's what the number would be if there were, some type of barrier. To get a lower number is just absolutely ridiculous and dishonest. But if you use the cost of goods index, and that's what my website's going to do, because a lot of times people will reach out and point fingers and say, you're a conspiracy theorist. Oh my gosh, yeah, it's not anywhere near where it needs to be done. But what you're going to see on this website is you're going to see the real rate of return. And this is embarrassing. I shouldn't have name dropped this. This is all under development, so don't judge me on this. But
Too
this is
late, buddy.
important.
Too
This is
late.
important data, right? So you know what? Here's what I want you to do. Just in the URL on the homepage, govflation.com/stage-home. And just to give people a better view, now that you got these skills, you can pull this up real quick like this. There you go. Okay, so this is what people are going
Oh,
to see. You're going to see these are the most important things that you need to see uh, as a money manager. Like if you're trying to protect your wealth, this is what you need to calculate. And to be honest, I'm sick and tired of manually doing this. So I'm in the process of automating this. And this is going to be a free website because this is critical information. Those charts that you see on there right now, they're just placeholders. We have custom interactive charts being built as we speak. But where we start is with CPI. So these numbers are actually government sourced. So that's really important because a lot of people will point to me and say, you're a conspiracy theorist. The data is not manipulated. And, it's true. The raw data is not manipulated. And thank God, the Bureau of Labor Statistics lets you get API access to this data. So the raw data is not manipulated. That's not what we're saying. It's the equations that they're plugging the raw data into that are causing the manipulations. So let's be clear about that. The data is accurate. The equations they're plugging the data into is what's causing all of the distortion between the reality of what's true and what they say is true. And right here, like for instance, US CPI right now, according to the government, is 3.2%. But if you go back to the cost of goods index, which is the original government equation, that's why we say right there, government sourced data and analytics. Truflation is its own proprietary interpretation of CPI. Govflation has nothing to do with our own interpretation. It's simply going back to the government's original interpretation and sourcing their raw data and plugging it into their more accurate equations for proper analytics and analysis. So CPI today in the United States is actually 11%, over 11%. And that's not my opinion. That's just based on their original equation without the manipulations, without the switch to the cost of living index, which allows them to make substitutions. And the reason that number is so important is because when you look at the real rate, well, the real interest rate or the real rate of return, you calculate that by subtracting CPI, by subtracting the rate of inflation from the highest US Treasury APY, right? So right now, because the yield curve is still inverted, the 3-month is the highest in the target range of 5.25 to 5.5%. So if you just say that it's 5.5%, you subtract it, the real rate of return is negative 5.57%. Now, that's really important because it's the real rate of return that incentivizes the marketplace, right? So in other words, when real interest rates are positive, the marketplace is incentivizing you to save because you're going to be able to buy more tomorrow. When the real rate is negative, the marketplace is incentivizing you to spend or invest because you're going to be able to buy less shares, smaller home, worse car tomorrow. So the real rate is the rate that really creates the true marketplace incentives for the participants. And that's a lot of why you see all of this huge money flowing into the market. Like, yes, there was a lot of money that flowed into treasuries, over $6 trillion worth sitting on the sidelines right now. By the way, isn't, the definition of a liquidity crisis is a lack of liquidity, right? Everybody's in assets and they want liquidity. They want dollars. So the assets sell off so that they can raise the dollars. But a lot of people right now calling for a liquidity crisis, it doesn't really make a lot of sense because there's $6 trillion of liquidity on the sidelines waiting to buy the dips. That's not how you set up for a liquidity crisis. It's setting up for the opposite of that. Those $6 trillion are going to realize, especially if rates are forced to go down, right? If they can't go higher for longer, and if the free market says, well, we believe they're still going to get the 2% inflation, or we believe they're going to be forced to lower rates. If they still believe that, then the rates can be forced lowered, and then that's going to make the rate even more negative, and people are going to rush out of those $6 trillion, and it's not going to be a liquidity crisis. It's going to be an asset crisis, and Bitcoin is going to be the fastest horse in that race, and you're going to see prices just explode forward, and it won't even necessarily be inflationary because those prices are exploding forward, not necessarily because of the dilution of the dollar through the creation of more currency units, but because of the supply demand price pressures and dynamics. A whole bunch of people coming out of dollars and demanding assets to the tune of $6 trillion. So it's going to be significant no matter which way it goes. But I think another important thing to say here is rates would need to go up another 5.5 percentage points here in the United States just to be neutral, right? So you hear them talking about the neutral rate all the time. We're nowhere near neutral, and we're trending a little bit better because I give them the benefit of the doubt and I or at least I try to. But the other thing is money supply. So you move to the next. These are all the most important things. Money supply, which they don't even keep track of anymore. They don't even keep track of M3 money supply. They stopped keeping track of it because it doesn't support their narrative. And this is baselined. You'll see there in July, August, October. This is actually baselined. So the zero line is right before COVID. Okay. So once we entered into helicopter money area, we baselined it to that. So I think that's a pretty important. There's you hear today, there's 31.98% more money in circulation, and it was higher than that. So yeah, it's come down a little bit, but that's not going to be enough, right? You can't accomplish the goals that they're declaring to accomplish by still having basically 32% more liquidity. And a lot of people don't like, or at least the people I bounce this off of, they're like, why is that red if it's positive? Well, because when it's red, it's bad for you, right? When it's red is bad for you. Green is good. So you can see most of what's going on right now is really bad. And if you go to GDP, it's the same thing with real rate. It's very interesting how the GDP deflator works, because it's not necessarily subtracting CPI. If you get into the technicals, it actually doesn't count imports. So it works a little bit differently. But the GDP deflator, just to keep it simple, is basically the CPI. So when you have GDP, you have nominal GDP, and you're trying to figure out what real GDP is, meaning that when you take away for price increases, you can measure economic activity. Well, we got plus 0.5% this last quarter, which was absolutely amazing. We were one quarter away from being in a depression, because when COVID kicked in, GDP was actually negative 10.15, which a lot of people know the definition of a recession is consecutive quarters of negative GDP. But the definition of a depression is 1 year where you have greater than negative 10% GDP, or 12 consecutive quarters or 3 years of negative GDP. Well, 2020 lockdowns put us in an artificial depression where we went negative 10 in not even just 1 year and 1 quarter. And then we've been building our way back ever since then. But we've been recovering. We haven't been growing. So when you look at what's really going on with real GDP, the economy has been slowly recovering, but there's been no real growth at all. We've barely recovered. And this was actually the 11th quarter. So if this was negative and then this quarter was negative, we would have met both definitions of a depression. We would have had 1 year of negative 10 plus 12 consecutive quarters of negative readouts. But this last quarter, we did get barely positive, but the economy is not in good shape. And I think everybody feels that, and that's why they're confident in the rates going down. But at the same time, when you look at what the real rate is, you have to understand that the rate can't go down, right? If the rate goes down, this real rate's going to go even more negative. And the more negative this rate goes, the more antsy that $6 trillion on the sideline is going to be hopping into the marketplace. So all of this is tied together to give you a snapshot of what I believe, in my opinion, what I use in my management system, the most important metrics to understand, to get a basic picture of what's really going on in the U.S. economy, which drives macro overall.